So I have been on this quest to learn about reverse mortgages. I'm a real estate professional for over a year now. And one of the things I've learned is the world of difference between those people who have it on their business card or their website as one of many tools and those who specialize in reverse mortgages as professional. I'm really lucky to have a return guest, Matt Harrison of Movement Mortgage, who is a retirement mortgage professional, specifically trained, specifically supported with this company for this product. Matt, thanks so much for joining us today.
Hey, thank you so much for having me on, Bill.
Now, I'm sure you also come across originators who do traditional loans. We call them forward loans in this space. Um, and as a real estate agent, I get the occasional approach from somebody who offers me to do a VA, FHA, conventional, construction, or this or that. I think there's no way you can do two of those, let alone all of them. Talk a little bit about what it was that caused you, from a career point of view, to choose to specialize in reverse mortgages.
Yeah, great question. So I think, and to hit to your point, I like to use medical analogies, and if you go into a general practitioner, they're going to be able to diagnose you, kind of give you an idea. They went to medical school. They kind of learned a little bit about everything. But, if I have something, wrong and it's an injury to my knee, and let's say that I need to go get surgery on my knee, I am not going to my general practitioner for that surgery. I'm going to be going to an orthopedic surgeon that specializes in knees, because I want to make sure that this is something that this particular doctor does every single day. They're an expert at it. They know a knee better than anybody else, and I'm going to want to make sure that that's the person that works on my knee. So when we look at really anything that we do, in the mortgage space, we have the same type of originators out there. We'll have those that can kind of do a little bit of everything, but then you have those that specialize in a program. For me, I used to be the guy that did everything. I originated forward and reverse, a little bit here, a little bit there. But it was my dad who came to me with a little bit of a problem. He was, needing to sell his house and move into something different. And, he really didn't want to have a monthly mortgage payment. And, retirement was looming, in a couple of years. And so, at that point, I dove into reverse in a much more meaningful way. And at the end of the experience, my dad, long story short, was able to buy a $620,000 home, and he only had to bring in $380,000. That was his cash investment. The reverse mortgage brought in the rest, and he was able to buy that house.
Nice.
But at the end of that, he said, Matt, why doesn't everyone do this? Why is this not something that the mainstream public will do on a regular basis? And I said, Dad, I've been in the industry for almost 20 years at this point, and I'm barely learning about it. And so I saw it as a huge opportunity to really dive in, learn about all of the nuances, and really understand this program on how it can supercharge your retirement and put you into a better spot financially. And so that was my story on it.
It's funny you say that, because I've been in this business for 40 years. I was an originator at first. I originated some of the reverse mortgages I call 1.0, the older version of it, and moved into real estate full time almost 20 years ago. But because I had done it, I thought I knew the product. And what's true about this product in particular, like everything in life, it's changed so much that all the things I knew were holding me back from using it. And I was shocked to find, for example, that this is an ideal product for many people, like your father in the story that you gave, like me when I was shopping for a property I didn't buy, but perhaps relocating or moving my primary residence to Florida a few months ago. I'm a real estate agent. I do a lot of business. I didn't know that reverse mortgage was even in the cards to think about. And that's why I launched this podcast. I said, well, if I don't know this, there are a lot of people that know this. And for all the struggling in the industry, for all the originators struggling and the realtors struggling, here's a case where if you just teach people what's available, you'll create more market share for yourself and the people that you work with. So I agree wholeheartedly. It really is about getting the word out. So let's talk about the first example that you gave with your father using it for purchase. I think that's probably the most underutilized piece of that. And I don't know why it's underutilized. That's why I have this podcast. We're going to get a bunch of people to watch this podcast to talk about it. But why do you think it is so underutilized, and what can we do you think to help make it more, at least considered in the toolbox before people make a decision?
Yeah, and I think some of this is going to stem back to the stigma of what reverse mortgages used to be or what people think that they currently are. And when you have a stigma, when you have an idea about what you think something is, you're already predispositioned to have an opinion about that. And unfortunately, reverses way back in the day, they gave themselves their own bad name, right? I mean, they weren't a good program. They did fit for some people, but FHA came in.
Too many people got ripped off and frauded by the first version. Way too many people.
Yeah.
It was set up. It was almost, and there's scams that were run off of them that really destroyed some people's wealth and got taken advantage of. I would call it the stigma, the stink of that program at that time. And I used it effectively, but if only 10% was fraud, that was a lot of businesses going down, and that's why the program had to get changed.
Yeah, and like I said, it is such a different program now, and so that's the first hurdle. The first hurdle really is education. Educating people on how this program works so that they can make a informed decision on if this is going to be a good option for them. So I think education is big. So when we talk about reverse in the purchase space, and I'll just go to my dad's example because it's a perfect one to look at. My dad had a $300,000 house. This was 7 years ago. And it just wasn't going to fit for him. He needed something bigger, better, nicer, that sort of thing. And so we moved into trying to figure out, okay, well, what can you buy? And he found something at about 620 that really kind of fit his needs. Well, if you sell a house for $300,000, you want to buy a $620,000 home, you have a couple of different ways to do it, right? You can pay for it cash. And so he could take $300,000 from the sale of his house and take $320,000 from his retirement and combine the two and buy this home cash. And there's a lot of retirees that will do this, right? Is it okay? Sure. Is it the most efficient way to use your money? In my mind, it's not, because you're parking money into an illiquid asset. And that asset, the money you park into it, has a 0% growth rate. What builds the value of your home is what the market is doing and not how much money you've put into it. So option number one, could he do it? Yes. Did he have the funds to do it? Sure. But he really didn't want to do it. Okay. He didn't want to take money from his retirement account in the tune of $320,000 to buy this home cash. His second option would be to use a normal traditional mortgage. So he brings in a $300,000 down payment. He has a $320,000 loan. And now he's got a mortgage payment for the next 30 years, that would be in the tune, back then it was about $1,800 a month. And, if you think about it, when you get into retirement years, your cash flow position is very important. How much money do you have coming in versus money going out? And if you don't have to make a housing payment, if you don't have to be taking $1,800 from your Social Security and your retirement portfolio to make a housing payment, would it be better not to? I mean, you might be able to, but let's talk about efficiency of money. If you don't have to do that, can you put that money somewhere else? And so my dad was in that boat. And so with the reverse mortgage, he was able to bring in he had to bring in $380,000 as a certain amount of percentage, depending on age, that you have to bring in as far as your down payment. Now, the reverse mortgage loan brings in the rest. And from that point moving forward, your obligation to make a principal and interest payment becomes completely optional. Now, Bill, when I first did this loan, I had no idea all of the other really fun things that you can plan when you have a reverse mortgage in place. I just threw this out to my dad. Dad, you don't have to make a payment. You only have to bring in 380. So he still had to liquidate 80 grand out of his retirement account. But for him and my stepmom, they do not have to make a payment for the rest of their lives, right? Mm-hmm. So when we talk about efficiency of money, he didn't have to bring as much in to buy the home cash. he doesn't have to make a monthly mortgage payment. He did have to take out 80 grand from his retirement account to do this, as far as the additional down payment. But if you just do the math, $1,800 a month in a payment you don't need to make, and divide that by 80 grand, is going to be, roughly, let me just do the math here since we're talking about it. Let's go 80 grand, and we divide that by 1,800 a month.
45.
It's 44 months. That's his break-even point. And so, a little about 3.5 years, all day long, that makes sense, right? So, for him, it was, why doesn't everybody do this? And Matt, you should be getting out there more and teaching. And, I think that's really what we're trying to do collectively as an industry, is teach people about how this program works. Is there a better way? Is there a more efficient way to buy property in retirement? And, we have a lot of fun with it.
That scenario, there's two challenges for people who are in retirement. One is they're used to not, in your case of a paid off house, they're used to not paying for a house. And so it's not just $1,800 payment versus renting, or $800 versus their current payment. It's really, they have been paying a mortgage, or they were thrilled to pay it off 5 years ago, and they've been living their life at an equilibrium with no payment. And so the idea of having to move and make a payment is a challenge. And the second is, you or I being in business, the truth is, you and I could easily go out and make 1 or 2 or 3 deals that would pay for that year's worth of payments by building a business. Once you're in retirement, you kind of lose the opportunity on the income side. Now, many people, could get a new job or a part-time job, or maybe retirees take up real estate, but it's not as simple as just flipping a switch and working a few more hours to make the money up. And emotionally, it's a big challenge. And so the idea of having a housing situation that makes sense with no payments due, at least is an attractive option that everybody should have presented them at some point.
Absolutely. Like I said, this is a pathway. There are multiple pathways to take, and not everyone is going to select this pathway. Yeah. But for those that look at it, and the one thing I love about this program, Bill, is this is a math-based program. It's a math-based program. And when you can see the math in different pathways that you take, whether you buy your home cash, or you use a normal mortgage, or you use a reverse, math is math. Right. And so when you're able to show people how retirement could look in each one of those pathways, that's when it becomes powerful, because again, that knowledge becomes power that they're able to use in that decision-making process as far as how they want to do this. And we're really only scratching the surface as far as all of the bells and whistles that come with using a reverse mortgage. Right. But, I get it all the time, right? Okay, Matt, I don't have title to my house, right? If I do a reverse, no, you still have title to your house. The bank does not own your property. Okay, Matt, so I hear that my heirs are going to be stuck with a bill at the end, and there's not going to be any equity left. Well, depending on where the value of the home goes, because there's no guarantee there. But if we just take a normal average 4% appreciation rate for property, which, by the way, if we look back over the last 80 plus years, I just saw this presentation by Barry Habib with MBS Highway. There have only been 5 years in the last 83 where we had a negative market in real estate nationally.
I think 4 of those like 1%. It wasn't really substantial. 4 of those 5.
Yeah, 5. So we can basically project out, hey, this is a comfortable growth rate as far as the value of your home. And yes, at some point, you're either going to sell the property or you're going to pass away while you're there. If you want to sell it, you list it for sale, you sell it, you pay off the mortgage balance. All the remaining equity position is yours. When you pass, your kids can either decide to keep the house by refinancing or paying off the loan balance, or for most of us, we're going to sell the property that our parents kind of passed to us because we can't figure out a way to split it 5 ways. So list it for sale, pay off the balance, and the remaining equity then goes to the kids. But in the event that for some reason the loan balance is higher than the value, we're repeating 2008 all over again. This loan allows for no repercussion to come to the heirs. So this is a non-recourse loan. The heirs do not have to come in with a single penny. And they can either walk away from it, they don't have to pay a dime, or they can still retain the property by paying 95% of the current appraised value and retain it. So there's a lot of protections that are in place with the program as far as that's concerned.
Well, the 95% I think applies only to the HECM version, the government-sponsored version of this, which is the vast majority of those issued. But just to put a little disclaimer on that. And I think that is an interesting point that, most foreclosures on reverse mortgages are either old reverse mortgages, back in the day when they did 80% loan to value, and the borrower lived a long time, longer than expected, and got all the money out of the house plus some. Their loan balance went up faster than the house, and they took all the cash. In which case, well, they got all the cash. I mean, if the house is upside down, on those old versions even, it's only because they got the cash, and there's no risk to the heirs. On the newer ones, there's a lower loan to value, so it's so unlikely to ever happen. But if it does, you can basically buy the property with a 5% discount on the HECM loans with a guaranteed short sale tool that's been added to the program. So there's a lot of great ways. The other way foreclosures happen is, and I get involved in this a lot, the decedents pass, maybe the parents in many cases, and the kids just ignore the reality that there was a mortgage. Maybe they don't know, and it's public record, you can check. Or a sibling's living in the house and hiding the mortgage statements and hiding the fact that there's foreclosure happening, and then all of a sudden there's a foreclosure posted. And that's just bad planning and bad management. But even there, I have a reverse mortgage SOS program where we can step in and help move things quickly to get done if necessary. So again, I think within reason, there's no excuse to ever lose the property. And even under extraordinary economic changes that might happen in the future, there's some built-in protections that make this superior than having your cash tied up and or for sure superior cash tied up and or other mortgages. So let's talk a bit about, we talked about the purchase side of it. How about the family? This is common here in LA, where somebody bought a house, in the 80s, maybe for $800,000 or $600,000, and had a $300,000 or $400,000 mortgage. And time's gone on now, and they still owe $100,000, $200,000, and they're making the payment. And maybe they're now entering a phase where their cash flow's tighter, so it's a refinance where they're going to pay off the loan, maybe take some cash for something, gift, vacation, estate planning. Talk a bit about using this tool as a refinance tool rather than just the for purchase version of it.
Yeah, great question. So, again, a lot of people right now that have mortgages have really good interest rates. They refinanced back in the day, they got a 2 or 3% interest rate, and they tell all their buddies about it, and it's something that they're proud of, and that's awesome. And I let people know that, hey, you know what, there's really nothing wrong with your current pathway. If you're making a payment and you've got a low interest rate, and you're able to maintain your head above water in your financial picture, there's nothing wrong with that. What we look at is there a more efficient way to do it, right? And so I love to ask this question, especially when I'm around financial planners. And let's say that, Bill, this is your mortgage, and you're paying $1,500 a month, and you got a fantastic rate, and you've got about 10 years left in your mortgage. Okay. The first thing that I would say is, all right, Bill, if I was your financial planner today, and I said, I want you to give me $1,500 a month for the next 10 years. So that's going to be a good chunk of change, right, over the next 10 years. I'm going to put that money into an illiquid asset. You can't touch it. And it gets even better. It has a 0% growth rate. How excited would you be, Bill, to invest your money with me at $1,500 a month for the next 10 years?
Yeah, well, I've done it on purpose.
Yeah. So in essence, that is exactly what we're doing when we pay a mortgage payment.
Right.
It is. Mathematically, that is what we're doing. We're taking money and we're putting it into a payment, into an illiquid asset that we cannot touch unless we get a loan on it or we sell the property. And that money that we're putting in is not growing for us. The market tells us what our growth is on the property, not how much money we put into it. Right. So what I like to challenge people to think about is, all right, Bill, this is your current plan. You're paying $1,500 a month. What if I was to ask you if you could find a better place to put $1,500 a month? Do you think you'd be able to find one?
Right.
If you didn't have to put it in your mortgage, could you find a better place to put $1,500 a month? Because, go ahead, Bill.
Well, see, this is why real estate investors almost always buy property with leverage because, if a property goes up 2 or 3% per year, that's not a great return. But if you put 80% down through a mortgage and 20% down payment as cash, that 2% per year is like times 4, and you get an 8% return. And if your mortgage is 6%, you're making more money on the equity of the house than on the mortgage over time. Once you've paid down that mortgage substantially, you've lost that leverage. And so at some point, it makes sense economically to re-leverage the house, whether it be borrow the money out and take the cash and invest it and arbitrage, or now, if it's your house, there's some different emotional issues, and those are things that somebody has to deal with. And there's different security issues and different estate planning issues. But as a general investor, no investor buys a property for cash or with 90% equity, because returns never work. They should always be able to get more return for the overall property than the interest rate they're going to pay on the portion that's the loan. And so a homeowner's in that same spot. Maybe it made a lot of sense when they bought the house. They didn't buy it for cash. They bought it for 20% down, and 30 years later it's paid off. They should be thinking about re-leveraging it to get better returns, and at least consider the option. I'm not saying it's right for everybody or even the majority of people, but everybody should look at it as a consideration.
Yeah, absolutely. I mean, if that money, if that $1,800 a month could instead be going to a new investment property,
right,
or something like that, to where you're building a rate of return that's going to be coming back,
right,
absolutely makes sense to do that. Because really, there's only 5 things you can do with money, right? You can spend it, you can save it, you can invest it, you can give it away to charity, or you can burn it. And I wouldn't recommend doing that, right? So, when you're looking at those opportunities, can that $1,800 a month payment potentially go somewhere else that could make you a better rate of return, whether that's in real estate, whether maybe it goes with a financial planner, allow the financial planner to help that build at 5 or 8 or 10% per year. Again, the math on that looks so good. It really does, when you start to think about, all right, how can I be more efficient with the money that I am using? Can I put it somewhere else that's going to be doing better for me? And so for anyone that has a home that they still have a mortgage payment on it, this is something that you should really start to digest. Could I put myself in a better spot? And by the way, Bill, if you had a 0% interest rate, you're still putting money into an illiquid asset with 0% growth as far as the money part.
right.
And could that be going somewhere different? And so we have to start to think about that in a little bit different light, because your home can be used as a tool to allow for you to build more wealth and a bigger nest egg.
So all that sounds great theoretically, right? Let's say I agree with the premise, but how does the rubber hit the road? Meaning, imagine I'm a homeowner watching this, or I'm a regular loan officer, forward originator, watching this thing. Hey, I have a customer might be interested in this. How do I go from, well, this is a great concept, to, well, how the numbers really look like for me? How much can I get? What can I do with that money? What's that return going to look like? What does the process look like from interested party? And then I guess obviously the same is true from a professional. If you're a financial planner of some sort, how do you go from this is a good theory to, hey, here's your options and you can borrow this money and here's what you can do with it? What does that process look like?
Yeah, so it's really simple. We talk about it theoretically, but again, this is a math-based program, right? Mm-hmm. So we, at Movement, we have a lot of software programs that are very simple to use and understand, and we can show those, with a client. And really, we only need a couple of very specific pieces of information. The age of the youngest borrower. Now, for the home equity conversion mortgage, or HECM program that FHA insures, you've got to be at least 62 years old. Or if you're married, at least one of you needs to be 62 and the other one can be under. Now, there are a couple of states, Texas, I'm talking to you, they're going to be a little different. Both have to be 62 in that respect. But for a majority of the United States, if you're married, at least one of you needs to be 62, your spouse can be under. But we're going to go off of age. That's a big factor as far as the initial information we need. Second, we need to know the value of your home. Approximately how much is it worth? And then along with that, what is owed right now on your current mortgage? And maybe you own it free and clear. We're going to get into that one here in just a minute. But if you have a mortgage, how much is that mortgage? And what does that payment look like for you right now? With that information alone, we can develop a proposal. We can go through a strategic planning session to teach you, hey, this is what your pathway currently looks like. This is where your money's going. This is how much money you're projected to spend over the next 10 or 15 or 20 years in the monthly payment that you're currently making. And put that side by side to what the reverse mortgage will look like for you, depending on if you're wanting to save the payment you don't need to make anymore and put it somewhere else, or do you want to spend it? Are you going to invest it? We can go through all of those scenarios. So again, you can see mathematically how this works. And you're also going to be able to see what's happening to the loan balance through time. And so that's really the easiest way to explain this. And that process, I mean, for the clients that I work with, Bill, we're generally looking at about a half hour to do some fact finding, make sure we understand where their scenario is. But this does not require a hard credit pull at this point. It does not require an application. This is just going through what the numbers look like for you today, how this will affect you. And again, we can start to have some fun with it. We've got the ability to look at someone's, nest egg as far as money that's invested in 401ks or IRAs. And let's say they're pulling out $4,000 a month. Well, how long is that going to last them, for their retirement? And what does that look like with or without a reverse mortgage to start to use in a coordinated strategy? But for the financial planners out there, that's where we have a lot of fun too. We like to blend in both the reverse mortgage and what they're doing with their assets under management to show a couple of different ways to help the sustainability of their retirement. And this is from studies that are done from PhDs in their own field. This is Dr. Wade Pfau, Barry Sachs, Jamie Hopkins that have already done the research and have come up with, the game plan for, okay, if you want to maximize retirement, this is how you do it.
So it sounds like it's fairly easy, unlike pre-qualifying to buy a mortgage, which is really kind of like a colonoscopy. It's just not as pleasant as a colonoscopy is. No offense to Movement Mortgage or my favorite originators out there, but come on, we can't give people a straight answer without, and it's because you can't give them an accurate answer in many cases without that. But on the reverse mortgage, and that would include, I guess, a reverse mortgage for purchase, really the whole consult is 30 minutes and you're going to pretty much know what your options are. I mean, obviously the value of the property has to be verified with an appraisal. You can call me and I can do some, we have 5 different automated valuation models. Zillow is one of them, but there's 4 others that are in many cases more accurate. So I can help with that if you ever need help with that. But you can give Matt a call and walk through, set up a time to do a consult and 30 minutes, at least see what your options are on paper. And if you're a financial professional, seeing a customer who maybe it doesn't have as much assets as they want and is sitting on equity, this is a tool that most financial planners, wealth management people don't talk about. I think to their detriment, I think to the customer's detriment as well. And that's the main thing is the customer. So Matt, I appreciate your time today. And I see on your website, you have a contact me button as well as your phone number and contact information. If someone wants to get with you, and if for some reason you're listening on the audio, reach out to me. You'll be more glad. I talked to Matt regularly. He's been a guest on this program a few times, but feel free to reach out. Phone number 801-330-2200. Great number, man. 801-330-2200. Matt Harrison at movement.com. And he is a professional in specifically reverse mortgages. Matt, thank you so much for taking time with us today. I really appreciate. I was learning a lot. More importantly, I think you really create a comforted perspective of this business to break it down, make it more simple for people. Thank you so much.
Thank you, Bill. As always, appreciate the opportunity.
And for the rest of you, this is Reverse Mortgage Weekly. We get together, Reverse Mortgage Podcast. We get together every week with mostly reverse mortgage originators like Matt, people who specialize in this field, sometimes management, vendors, to learn how to be more effective with our customers and our referral sources. If I can help, reach out. I'm at Bill Gross Probate on social media. If you have questions, comments, put it in the chat. Send me an email, like, subscribe if I can help. If you want to be interviewed on this program as well, feel free to reach out to me. I'm always looking for good guests. You can't be as good as Matt, but I can get you on as well. So if I can help, reach out. As always, make today your best day ever. Thanks so much.